The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
Welcome to About Money. We're going to be talking about money today because it's Friday, and we always talk about money on Fridays. Anyway, remember back in the 80s and 90s, they came up with this idea of securitizing mortgages, building these packages which they then sold to investors. Collateralized mortgage obligations, collateralized debt obligations became a disaster. It was as subprime mortgages caved in, other mortgages caved in, and we had the Great Recession. A lot of other factors figured into it, but that was the key factor. That was a key investment which brought the house down. Now, that led to the Great Recession, but I think we're in the process of repeating something which is not going to repeat the Great Recession, but could be a huge, huge disaster. It's an investment in 401ks. The money is pouring into this investment, and I think it has the potential to be a huge disaster, an impact greater than the Great Recession for retirees, those who have this investment. Going to talk more about that. That's coming later in the program, so stay with me for that. Lots of things to talk about today. I've got a great guest today, got a great story. And, you know, if you like what you're hearing, we have a blog on the website. You can log into the blog, get additional information on topics that I'm talking about today that I've talked about in past weeks. AdamsFinancialConcepts.com. I go further into depth. You have that. And we also have a Twitter account. So at About Money Radio is our Twitter. You can log in there. And even as we're doing the radio program, we're tweeting. You can do that. You can also like us on Facebook. Do all those things. And if you have questions, you can actually contact us during the program by tweeting us. So do that. So I want to talk about what's gone on. The big news in the financial markets, of course, is Wells Fargo. Wells Fargo, 5,300 employees fired. Stumpf has testified before Congress. He's been grilled and grilled and grilled. And so what's gone on? What kind of culture? And it is a problem of culture, in my opinion. What's really going on? I used to say that banks and brokerage firms don't really get along. A bank was a culture that you never got in trouble for the loan you did not make. It was a culture of saying no. Brokerage businesses are in the business, if you don't say yes, you don't make money. Those two cultures are very, very distinct. But what happened is as banks acquired brokerage firms, that whole culture thing began to change. I really believe that's when it started to happen, and that's when banks began to take different risk, different choices, and they began to surge into the brokerage industry. When banks were existing just as banks alone, and there was a wall separating the two, that wall kept brokerage on one side and banks on the other. Banks had a huge number of assets and made a very small profit on those assets. If you looked across the wall, the brokerage firms had a limited number of assets, but made a whole lot of profits when they were profitable. And the banks seemed to look at that and say, we can combine those. We can have our assets and make a whole lot more profits. In my opinion, that's what led to the situation at Wells Fargo. But it took an additional step because Wells Fargo, in my opinion, got greedy. It's a situation where the entire culture in a brokerage firm is targeted towards sales. In banks, it used to be they took your money, they loaned it to people. It was not about them pushing a lot of loans out the door. But in today's market, where you have the banks and the brokerages combined, you have a situation like Wells Fargo where they talked about cross-selling, and 8 is great. That was their motto. They wanted you to have 8 different products: a checking account, maybe a home mortgage, maybe an auto loan, credit cards, financial planning. You might want retirement planning in their trust department, an annuity, insurance products, business banking, equipment financing, commercial real estate, student loans, boat loans. They made a large gamut. And the idea was if you had one account, they wanted you to have at least 7 other things you belonged to. You had that kind of business. They wanted 8 is great. And they thought that built the relationship with the banking customer. And they wanted that whether you needed it or not. There was no one that ever asked the question, is it in the customer's best interest? No one ever asked that question. The question was, 8 is great. And so if you have only 3, you need to have 5 more. And that pushed the sales culture, the bonuses, and sales goals. Sales goals for bank tellers. Can you imagine a bank teller having a sales goal? That doesn't make sense to me. That just doesn't make sense. But that's the concept that Wells Fargo had. And maybe other banks have that as well. It just hasn't blown up for some of the other banks. But it's the idea that they had sales goals to meet. And if you didn't meet the goals, you could lose your job. So what happens? If you're not meeting your sales goals, there were some that stepped over the line, and there's no question when they created accounts for customers that the customers didn't want, when they put out a credit card and the customer got charged credit card fees, when they opened a savings account, when they opened a debit card, whatever they did, all those things that were done were wrong. No question about that. And those people were wrong to do it. But it was the culture that influenced them to do that and the pressure to do that. You can't have that kind of a culture and expect that some people won't respond to it. No one asked if it was in the best interest of the customer. It was always what's in the best interest of the bank. There was a lot of talk, and there's been a lot of talk during the election time. There was a talk as we came out of the Great Recession, and a bill was passed, the Dodd-Frank bill. And part of the Dodd-Frank bill was to ask for a fiduciary standard. And if you listen to Barney Frank talk about what went on, they wanted to have, as part of the Dodd-Frank bill, a fiduciary standard for everybody that worked in the brokerage business. A fiduciary standard. For me, the fiduciary standard is a very simple thing. One question: is it in the best interest of the customer? Is it in the best interest of the client? They wanted to have that, but there was so much pushback against that instead of coming through with a fiduciary standard in Dodd-Frank, they shifted it forward. They kicked the can down the road. They said, we will kick it to the Securities and Exchange Commission and ask the Securities and Exchange Commission to have a fiduciary standard. Well, we're still waiting for that. Mary Jo White, who was head of the SEC, has said that she will have one by April of next year. We'll see how that goes. But something in the meantime happened is that the Department of Labor, in reviewing 401ks, and I've talked about 401ks on this program a number of times. I've talked about the fiduciary standard a number of times. The Department of Labor, looking at 401k plans, almost 500,000 plans, found the fees were excessive. Sometimes up to half of the returns in 401ks were going to Wall Street. when Obama sent the letter to the Department of Labor asking the Department of Labor to develop a fiduciary standard. The study showed that up to $17 billion per year was being earned by Wall Street unjustly. Just like in the Wells Fargo case, for those accounts that were opened that customers didn't want, or the 8 is great, pushing customers into products that they really didn't have a use for, didn't want. So it was in the 401k business that you had that big push to put people into products and for fees. I've mentioned it before. A Department of Labor study found up to 17 different fees, and most of those fees were hidden so that participants and sponsors never saw what was really being charged. But there was a great pushback. For me, the fiduciary standard is very simple. It is something that should be what is in the best interest of the client. But there has been so much pushback. Wall Street's worried about losing $17 billion. So the final fiduciary standard that will go into effect in April is now over 1,000 pages long. Why 1,000 pages? We're coming to a commercial break, so don't go away. I'll tell you after the commercial break why that very simple thing has to be 1,000 pages. Don't go away. We've got a lot more on this program today. Stay with me. We'll be right back.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I've been talking about the fiduciary standard and the culture that existed at Wells Fargo Bank and the culture around this whole thing about the fiduciary standard. For me, it's a very simple thing. What is in the best interest of the client? Every decision by a financial advisor should be made in the best interest of the client. There's 2 types of financial advisors. As a way of background, I've talked about this before. You have the registered investment advisors, like we are at Adams Financial Concepts. We fall under the Investment Company Act of 1940. Means that we are fiduciaries. We have to make every decision in the best interest of the client. You have the big brokerage firms, the Wells Fargo, the Merrill Lynch, the Morgan Stanley. They fall under the Securities and Exchange Act of 1932, which means their financial advisors only have to make decisions for a suitable investment. And what does a suitable mean? It can be more expensive. It just has to meet some of the objectives of the client. So when Dodd-Frank, or when the Department of Labor came out with the fact that they were going to do a fiduciary standard, instead of one simple sentence, there was a huge amount of pushback. Wall Street was looking at losing $17 billion per year. Huge amount of pushback. So last February, I was in Nashville at the National Association of Pension Advisors and sat at lunch with the lobbyist and with the some of the top people that are in the National Association of Pension Advisors, and they talked about their work on the Dodd-Frank. They drafted a lot, or not the Dodd-Frank, the Department of Labor fiduciary standard. They drafted a lot of the language that went into it, and it was taken almost word for word. Now, the issue is, how do you know what's in the best interest of the client? If the client makes an investment and the investment goes down, the client can always claim, that wasn't in my best interest because I lost money. I make those decisions, and some of the stocks that I buy do go down. Some of the times we take losses. The idea is to put together a portfolio where over the long term, you make money. But if somebody takes a particular case where once they have one stock, it goes down, they have a loss, can they sue the brokerage firm? Sure, because they can say that wasn't in my best interest. There was a lot of fear about that. There was a lot of fear as well over this whole thing that happened that is exemplified by Wells, in that for the large brokerage firms, they don't want to make every decision in the best interest of the client. They want to make every decision in the best interest of the firm. And if that aligns with the client, that's good. But otherwise, they want the decisions to be made in the firm's interest, not in the client's interest. I spent 18 years. I started at Payne Weber, which is now UBS, went to Dane Bosworth in 1990. Dane is now RBC, and from there was recruited to Evren, which became First Union, which became Wachovia, which became Wachovia Securities. I had the same office, the same desk, the same phone number, the same address, all working for 4 different companies, but that's the way it is in the brokerage business. And the whole focus in those firms is a sales-oriented culture. Cross-selling is magnified. Pushing is very hard. It's about how much revenue you produce. It's all about production. There's a grid that starts out, and you make maybe 42% of the revenue you produce if you're above a certain level. If you're producing $400,000 or $500,000 or $1 million, if you produce $250,000, it drops to 38. If you produce under 100,000, it might drop to 25%. It's to force the people at the bottom out. But that's the grid. So number one, it's a grid, and your payment puts pressure on producing. Secondly, titles. Titles depend upon how much production you have. I was a senior vice president, which meant I had a lot of production. But you also have vice presidents, you have first vice presidents, and you have account executives. Or now maybe they call them financial advisors, I don't know. But if you produce a certain amount, you get to become a senior vice president. And you also belong, if you produce those levels, you get to be either in the president's club or the chairman's club. And if you look in my office, actually there's plaques showing that I was in the chairman's club and the president's club during my time in the business. What that means is you get a little bit of an expense allowance in the president's club, and the chairman's club you get a little more. But what's more impact is you get a trip. The president's club, it was all domestic trips. So we went to Napa when I was in the president's club. Chairman's club was half the years it was domestic, half the years it was international. So we went to Madrid, we went to Amsterdam, we went to Cabo, and on the domestic to Orlando, to Phoenix. That was chairman's club. That's what you got if you were a big producer. You also got a bigger office. I had a corner office. If you were a small producer, you got to be in the bullpen. It was everything geared toward pushing up production. And that is the culture of being in the brokerage business that is shifted over to the banking business. Instead of being conservative, the focus is on a sales culture to move people on production into bonuses. And they'll take away the bonuses based and commissions based, but still My guess is that there'll still be a sales culture that'll depend upon all these things: titles, trips, expense accounts, where you sit, what kind of a desk, how big a space, what an office you have. And going along with that, over the years, it's not been just that. At Merrill, coming out of the 1987 crash, Merrill wanted their advisors, their account executives, their producers, to sell financial planning. The idea was to bring all those assets in-house, and the more money you brought in, the more revenue came in for the financial advisor, the more money came in for Merrill. It was not in the best interest of the client. It was in the best interest of the company. And I disagree with a lot of the financial planning. I have a whole different approach, but that's for another program. At Payne Weber, where I was, the idea was to sell insurance annuities, guaranteed income. After going through the crash of 87, here's something that's guaranteed. And it was at zero cost because it was a loss leader. Once you got people in, you brought the money in, then after 6 months, and it only lasted 6 months, then you can move them into a very risky, high-risk investment that paid you a lot more money. Or you can move them into another annuity, which could pay up to 10%. That was the culture. That's where it was. And that's what is going on at Wells Fargo and a lot of the brokerage businesses. That's the culture. And if you exist in that time, you have to know that the interest is not your interest that they're concerned with. It's the company's interest. That's what's gone on. You know, for Wells Fargo, I hope that Stumpf goes to jail. I think the greed and the non-accountability, the senior executives didn't get fired, and until he appeared before Congress, he wasn't going to give back a cent. He was going to push all the blame down to the people at the very bottom. It just doesn't seem right. It doesn't seem right. Anyway, hopefully that gives you a little insight into what goes on in brokerage businesses and what happens. I've got more coming in this program. I've got a guest I want to introduce. I also want to come back to one of the products which I think has a potential disaster, but we'll have to wait for that. First, I want to introduce Donn Harvey of Protingent. Welcome to the program, Donn.
Thanks, Mike. It's great to be here.
So why don't we start with your background?
Okay, well, it's kind of interesting, or maybe not. I was oldest of five, grew up in Milwaukee, Wisconsin, in a working class family. Back in the day, it was expected, just understood that if we were going to go to college, we paid our own way. So I worked a number of jobs and actually got married. My wife helped me pay my way through college and graduated from engineering school. Moved out here in the 80s to work at Boeing at the High Technology Center, and I continued my education at the University of Washington, pursuing my master's degree.
And then?
So in the Boeing Research Center, we worked on antennas for phased array antennas for satellite communications, and it was all interesting. But the tech boom was starting in the .com, and I left that to go to a startup tech company that was doing antennas for the cellular industry. And there I was director of engineering, where it was my job to hire quite a bit of the engineering staff.
Mm-hmm.
So after I learned all that, hiring engineers, I decided I could do this as a business, and I started a temporary staffing agency with a focus on technology workers back in 2001. So it's 15 years later now, and it's been a successful company.
It's appeared a number of times on the fastest growing companies.
Correct. Yeah, we've been on the Puget Sound Business Journal's fastest growing list 5 or 6 years. Now at the Inc. 5000, it's kind of hard not to be on that one. So we've been recognized by some industry publications. And the last 3 years, we were awarded Best of Staffing from an independent company that surveys staffing firms.
Congratulations.
Yeah.
Very good. So let's, in a nutshell, or very briefly, tell us what Protingent does.
So Protingent provides temporary workers to technology companies, and we have a niche in product development engineers. So all our customers make a product, and they might need a temporary worker for a peak workload situation, or if they need a specialty skill set, or to staff a project where somebody's on vacation or gone. And it's a lot of work, but it's a fun industry.
We're going to come right back after this commercial break, and we're going to take a greater depth to talk about all this. So don't go away. Got a lot more to come.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
Welcome back, and I'm here with Donn Harvey of Protingent. We started to talk about Protingent. Let's talk more about what your staffing does.
Well, like I said, our focus is on product development engineers. All our customers make a product, so something, either a software or hardware product. And our main focus around the Northwest, we're in Washington, Oregon, and California. But we work in the software industry, of course. We work in the integrated circuit industry. We work in medical devices industry. And a big one that's been two kind of new ones that are growing for us are automotive technology and gaming. So those are some great areas to be in. And all of these companies need technical workers to get their products out the door. And in this economy, it's not very easy to find these workers. So they call us.
So when you say about this economy, not very many workers.
Right. So it's all up and down the West Coast in the markets that we play in. I would say there is a shortage of tech workers. There's more demand than there are people available. And so companies are struggling to find the right workers to get their projects done. And in the industry, we call it the war for talent. How do you get these people? How do you attract them? How do you keep them? The role we play is there's a number of companies that like to bring workers in on a temporary basis, kind of see how they work out. And so these are companies that it might be very hard to get into otherwise. And so we find workers that might want to go on a 6-month contract or a 1-year contract at a major high-tech company. And then if they like working there and the companies like them, then they get offered full-time employment. That's the case about half the time lately. About half our workers that come off assignment end up going on to work for the companies.
And usually when they contract with you, they contract for a certain period of time, the companies, and they have a project that will take 6 months or 9 months or a year to complete.
Right. I mean, they estimate the time and they say, we think it's going to be 9 months, but, they don't know for sure. And so the nice thing is, it's flexible on the client's end. On the contractor's end, working for us, they're regular employees of our company, and we provide the benefits. So we have a pretty good health insurance plan. We have a 401k plan. We have a retirement plan through our ESOP, and we have vacation time. And, we really take care of all the contractors that are out on assignment for us. And so for them, it's a regular job. They're not worrying about invoices and worrying about paying employment taxes on their own. And it's good for the company because they just pay an invoice and they don't have to worry about all the HR responsibilities that we take care of. So it's really a win-win for both sides.
So your people are actual W-2. They're not 1099.
Correct. Everybody's a W-2 employee for us. There's really been a move away from 1099s the last 5 years. They call it employer misclassification. It's a big buzzword in the industry. And many companies won't go direct with 1099 employees anymore because there's too much risk that they might get in trouble for not paying basically the taxes, employment tax. It all comes down to the federal government needs the money.
Yeah.
I think.
So when we talk about the economy, one of the big things has been the growth of the gig economy.
Right.
How does that play into what you're doing?
So I like to look at it like this. I think and I'm going to talk about the tech space in particular because that's what I'm most familiar with. There's a spectrum of work in the labor market and the tech workers, and on one end of the spectrum is the gig economy. That's very transactional, very short-term projects. It's typically somebody bids a project that they'll do from home, write some software code, debug something, and those might be short 1, 2, 3 week assignments. Those tend to be 1099 through the whatever firm they use. And then there's the longer term staffing model that we're in, and these are 6 to 9, 12. We've had people work as long as 4 years. So we're in this middle ground where they're longer term assignments, there's benefits, and they work for an actual company with a W-2. And then, of course, on the other side of the spectrum is just full-time employment with a company. So each of these things have their place. You know, companies might need a short-term, hey, can you just debug this code? Or somebody might need a regulatory compliance engineer to come in on a longer-term assignment. Or if it's an ongoing need, companies just hire somebody. So it's all about having a flexible workforce for the companies nowadays.
And so with as tight of market it must mean that you have to really do your homework and do your work to acquire your employees.
Absolutely. This is what we spend all our time doing. At Protingent, we have a fantastic team of recruiters, and we have a database of 100,000 or more engineers, and we really keep track of where everybody is. People that are working for us, in the weeks before their assignment's over, we're working on their next job. People that are on even working for somebody else that are going to be coming available, we're already working on their next job. And you're not going to win if you just wait for somebody to post their resume on Monster. It's almost too late. You know, we build relationships and we keep in touch with people, and that's what really gives us the edge. And that's why our customers call us, because they know that we have access to people that their resume is not Monster or any job boards. These are people that we have a relationship with. And not only that, we have an incentive with our benefit plan for people to stay with us for assignment after assignment after assignment. And that's worked out pretty well, too.
And I would imagine that you have to really understand what the client is looking for and furnish the right type of people.
Yeah, absolutely. And this is really the premise I started the company on. I was director of engineering. I have an engineering background. And some of these positions are very hard to even understand what the customer wants. And so oftentimes I'll work with the sales team to go out to the customer site and listen to the technology they're using. And then I'll come back and work with the sales team and say, okay, this is the kind of engineer they need. Here are the key things we should look for on a resume. When you interview, ask these questions. And this really helps us narrow down, find the perfect person for the job, and then submit it to the company.
I mean, what comes to mind, of course, is healthcare. When somebody's developing a product for healthcare that has to go through the regulation, that's something that somebody would have to know a great deal about to be productive.
Yeah, absolutely. The medical device companies we work with, they want people that have experience in the medical device industry and understand the regulatory environment and how things are supposed to be done a certain way. So fortunately, we work with a large number of medical device companies, and we can facilitate a little bit of musical chairs. and there are, there's not secrets going back and forth, but everybody understands if you're designing, a defibrillator or an ultrasound machine, you're still in that regulatory environment. And we're able to kind of make that connection for our clients.
So if one of our listeners happened to have a product that they need to have you take care of, how would they get a hold of you?
Well, the best thing to do is really go to our website is protingent.com, Protingent.com. And Protingent's just a conjunction of contingent workers and professional, so professional contingent workers. On there, you can click a link, request an engineer,
So would you repeat their website just in case somebody didn't?
Protingent, PROTINGENT.com.
So if you have a need, do contact them.
Thank you.
Great company. They have a great story, and there's a reason why they're growing so fast. So thanks for being on the program, Don.
Thanks, Mike. Great to be here.
Very great story.
Okay.
So I want to shift now. I talked about one of the products that's appearing in 401ks that I think has the potential to be a huge, huge disaster. Now, to understand where I'm coming from, the product I'm talking about is the target date fund. But to understand where I'm coming from, we have to talk about what's going on now in the economy, what's going on in the markets, and what could be coming. Right now we're in a secular bull market. If you look back a ways, you'll see 1982, we started a bull market that finished in 2000. It was 18 years long. If you look beyond that, you'll see that we had a bull market that went from 1942 to 1966. Long-term bull markets. There were corrections in between. There were ups, there were downs. But in general, you had a market that continued to go up. 1966, the market hit 1,000 for the first time, had come from 100 in 1941, increased tenfold. And then in 1966, it hit 1,000 and bounced around, bounced down 20%, back up, down 30%, back up, down 40%, back up, down 20%. And then it hit in August of 82, 1,000. And that market went from 1,000 to 10,000. We're in a market right now, which I've been talking about, is a market which I believe could be 100,000 before we're done. But it will come to an end. And how it comes to an end is important to understand. We can't predict how things are going to happen, but we can prepare. Howard Marks said that. I like that. We can't predict what's going to happen, but we can prepare. And I believe we need to prepare, and need to prepare beginning now and continuing for the next 10 or 15 years, for however long this market's going to last. Prepare for what? We're coming to commercial break. That'll come right after the commercial break. Don't go away. Got a lot to say.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and, probably most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So I started to talk about how this secular bull market ends. And we've got a ways to go. We could have another 10 years, 15 years, 8 years, who knows? But I believe that we're in the process. I've been talking about this for a number of years, that we're in this super cycle when the worldwide economy grows faster than the average. It's being driven by the emerging markets today. And it is a time in which we're seeing poverty disappear. We're seeing a lot of things happen. It's a very positive time for the market. People are consuming, wealth is increasing, affluence is increasing, but at some point, that will come to an end. And while we can't predict exactly what will happen, we can prepare. Now, if you think about the 2007, 2008, 2009 Great Recession, now you have a lot of people who say they predicted it. You know, that's hindsight. They didn't really predict it. There were very few people that really predicted what was going to happen. Very few people prepared for what could have happened. I think I did a partial job of preparing, but I never guessed that we were going to be in a crisis like we were. So what's coming, I believe, has a greater probability of inflation rather than a time in which the market drops at the bottom. And I've talked about this a few more times. I've talked in greater detail. But if you think about it, for the generation that grew up in the 1930s and went through the Great Depression, when they came into power and they had a recession taking place in the 1960s and 70s, they were willing to inflate their way out of the recession. They did not want another Great Depression. So when we got to the 2007, 2008, people remembered what the inflation was like in the 1970s. They did not want to inflate their way out of what was going on. And so we took the Great Recession. Those were the people that grew up during the inflationary times when they were in power. They were willing to take a depression to keep from inflating out. I believe that the people that are growing up through the Great Recession that we've just gone through, as they come into power, they're going to look at that period of time and they're going to be willing to pump money into the economy and cause inflation to go again. Inflation is not one of those things that's like the Great Recession. It's a slow buildup. I talk about the numbers. In 1962, inflation was 1%. By 63, 1.3, 64, 1.3, by 65, 1.6, 66, it was 2.9. By 70, it had grown to 5.7. By 72, it was hanging at around 4. 73 began to take off because we had the oil embargo, and people began to be aware that we were in an inflationary time when OPEC started holding back on oil. It was then that inflation really took off and would soar into the double digits. A lot of people think of that time as that's what started inflation, but if you go back and look at it, it started in the early 1960s. It was a gradual, slow growth, but by the time OPEC hit, we were already at 5 or 6% inflation. Now, there's no way to say that that's absolutely what's going to happen, but I think there's a greater probability of that happening than going through another Great Recession. So what does all that have to do with 401ks? What does that have to do with target date funds? The big thing about target date funds is they talk about the glide path. The glide path. New term, special thing, the glide path. Means that for somebody that's got 40 years before they're going to retire, they're going to have 20% bonds, 80% stock. That's the way it's structured. And that during that period of time, you're going to look at a curve that slowly slopes down to reach the point where at age 65, when somebody retires, or 67, whatever the retirement age is going to be, at that point, they're going to be 80% bonds, 20% stocks. Think about it. Started 80% stocks, 20% bonds, and at the end of the glide path, 20% in stocks, 80% in bonds. That is geared toward prevention of another Great Recession investment. So if we have a Great Recession, when somebody begins to retire, they're going to be locked into bonds and a fixed income. Very, very works. That glide path works very well in the case of a Great Recession. But think about it. If the probability favors inflation rather than a Great Recession, if that's where we end up, what impact is that going to have As that glide path goes down, as people are 80% in bonds, 20% in stocks, what happens? We already know from the 1970s where things went. Bond prices caved in. We saw some bonds drop in value from par to 20 cents on the dollar, an 80% loss. Some of those low coupon bonds that were issued in the 1960s, we saw them cave in. They were wonderful in the 1980s because you got a lot of capital appreciation, but that's a lot later. For a period of 15 years, those bonds continued to tick down, 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 down. The purchasing power continued to drop and drop. Very significant drop in the value of those bonds. Now think about it. For somebody who has been putting away money in their 401k and they're on this glide path, they reach retirement age, they're 80% in bonds, and inflation is beginning to tick up, those bond values are beginning to drop. 80% of their values are going to continue to drop, drop, drop. Every year, the value is going to continue to decrease. That, in my opinion, is the huge risk of the target date funds. And right now, it's a very simple thing. They are QDA. They're the qualified default investment alternative. So that if people don't choose what they want as their investments, that's what the default is. And it's sold as the idea that it's a very simple thing. You can put your money in and you'll be set for retirement. That's the issue. Some plans require that target date funds be in the plans, and they're sold. It's the most popular investment, the fastest growing investment in 401ks, percentage-wise, of any investment. I think like collateralized mortgage obligations, like collateralized debt obligations, if the inflation impact happens to end this secular bull market, not only will it take down stocks, it'll take down a lot of retirement accounts. Can it happen? I hope that it doesn't happen, but I think the idea is we can't predict the future, but we certainly can prepare for it. And as we build plans, I think that's one thing I'm not going to be putting any of my clients into. And if you're in one of those, I would suggest that you evaluate where you are. I think the glide path will be a glide path to disaster. That's my opinion, and that's where it is. That's it for today. We've got a lot more things coming up next week, a lot more details. So join me. We'll have another great guest next week. And if you missed any of this program, you can pick it up on our website within a week or so. So have a very good weekend, and I will be back next Friday. Have a great weekend.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams, here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.